Please write down a note for the basic understanding of the chapter. Heading, write down investment decision. In bracket, write down capital budgeting. In that, write down first point. In this chapter, we are going to learn decision making about different situations. Full stop. Second point, we are going to understand decision making in a respect of, write down one, single project evaluation. Dear student, single project evaluation means whether a specific product should be manufactured or not. That is called single project evaluation. Whether we should expand our business or not, that is single project evaluation. Second, replacement decision. Third, decision making in a situation of capital rationing. Fourth, decision making for mutually exclusive investment proposal. With paragraph write down. And other such a decision making. Full stop. Third point, for the purpose of decision making, comma, we have following techniques. In the write down A, NPV, B, NPV index. Write down in the bracket net present value. C, PI, in bracket write down profitability index. Friends, it has a different name also called DF. The term DF stands for desirability factor. Desirability factor. At the same time, it has a different name called BCR. Benefit, cost, ratio. D IRR, in bracket write down internal rate of return. E payback period. F discounted payback period. G ARR, in bracket write down average or accounting rate of return. Fourth point, for certain decision making, only one method can be applied, comma, for others more than one can also be applied. Full stop. If nothing is specified, comma, we can apply any one of the permissible method for decision making. Now don't write anything, let us have a discussion. Don't write it, that is write anything, let us have a discussion. I am discussing a technique called NPV technique. Uh, Having a discussion like this. Suppose one of your friend is approaching you with a point that I want to manufacture a product. You just help me to decide that whether I should manufacture the product or not. That is a kind of project which you have to evaluate as like one of your friend is considering manufacturing of the product. Suppose you are applying the NPV technique for the purpose of decision making. Then in that case, the first thing that say you have to ask to your friend is about some data or some information for the purpose of decision making. The kind of the data or the information that say you require is like this. First, that what would be the investment that say we have to make. The investment that say we have to make in working capital, investment that we have to make in the fixed asset, Like that, say that kind of certain information is required by you first of all. Second, let us say that say whatever the plant and machinery for which you are required to make investment, for that say you want to know that what will be the life of machinery. Let us say the life of the machinery is 3 years. Then you would like to gather revenue data, expenses data, the amount of tax liability, then what is the cost of capital, in a way that say what is the rate at which the return is required. Like that, say these are the certain basic details that say you require from your friend. All this information will be provided to you. Now in case of NPV technique, friends, what will you do? The very first thing is that say this information is required to be converted into cash flow term. This is required to be converted into cash flow term. Of course, we understand that say usually it is the year 0 in which you have to make investment. So what will happen? You will have the cash flow series like this, wherein in the year 0 you will have investment, that is outflow. End of year 1 inflow, end of year 2 inflow, end of year 3 inflow. So basically you are required to convert this information into cash flow term, in a way that say what I am going to receive, what I am going to pay, sales minus expenses, profit before tax minus income tax. If at all depreciation is deducted to compute the profit, then it is added back. Working capital investment that you have to make, fixed asset investment that you have to make, and all so on. So in NPV technique, what happens, friends? This information is required to be converted into cash flow term. This is what we understand. Now, friends, NPV technique says that whatever the future cash inflow that you are going to receive will be discounted in present value term. You will compute the present value of the future cash inflow. So let us say that say whatever you are going to receive, 1000, 2000 and 3000. You will compute the present value of the cash inflow. And let us say that say it is an amount of 4500. My question to all of you is this. I request all of you to answer in the chat box. My question to all of you is that suppose investment is rupees 4000. Investment is rupees 4000. Then in that case, will you accept the project? It means that say whether your friend will be advised to manufacture the product or not. So friends, over here we understand that if at all the present value of the cash inflow is 4500 and the investment is 4000, then in that case the net present value is present value of the cash inflow minus investment. So it is 4500 minus 4000, that comes to 500. And since NPV is positive, we understand that the company should accept the project. So in that case we understand that the company should manufacture the product. So whatever you receive in the present value term exceeds the amount of investment, then in that case you should accept the project. That is a simple decision making that we have. Now my next question to all of you is, suppose the amount of investment is an amount of 5200. Then in that case whether the product should be manufactured? Question mark. The answer is no. That if at all the amount of investment is 5200, we should not manufacture the product. This is what we understand. Again, the reason for that is very simple. What is the present value of the cash inflow? 4500. What is the amount of the investment to be made? 5200. So what is the amount of NPV? 700. Is it positive or negative? It is negative. Since NPV is negative, so in that case we should not manufacture the product. This is what we understand. Why? Because what we receive in the present value term is only 4500. and what we invest is 4,000. 4,000 is less than 4,500. So that, I'm sorry, what we receive is 4,500 and what we invest is 5,200. So if at all we have to invest more than what we are going to receive, then in that case we should not manufacture the product, we should not accept the project. So concluding the point, friends, as far as the NPV technique is concerned, the first technique which I want to introduce to all of you, this technique says that you are required to make the computation of the relevant cash flows for the purpose of decision making, and you'll compute the present value of the future cash inflow. From that, investment is deducted, or we can say present value of the cash outflow, and NPV is positive. If NPV will be calculated. If NPV is positive, we should accept the project and vice versa. This is the way we are required to take the decision. Head on heading, net present value criteria, NPV criteria. Net present value. In the written first point, as per this method, comma, for the purpose of decision making, comma, we will compute relevant cash flows for the project. Second point, we will find cash inflow and also outflow. Full stop. Future cash inflow will be discounted in present value term for the purpose of decision making. Next point, NPV will be calculated comma using following formula. In that account, NPV is present value of cash inflow minus investment. Present value of cash inflow and this is investment. Based on NPV calculation, comma, we will take decision as under. In the breakdown, NPV is greater than 0, then the decision is A. A stands for accept. NPV is less than 0, R stands for reject. NPV is equal to 0, then I stands for indifferent. This is the way we are required to take a decision. So let us see the question. X Limited is considering purchasing of a machinery. Purchase price of the machinery is 10,000. Cash inflow with the purchase of machinery is as under. So what will be the cash inflow is given to us. First year 4,000, second year 7,000, third year 18,000. Discounting rate or cost of capital is 25%. You are required to answer whether machinery should be purchased, that is a question. Now friends, over here, for the purpose of decision making, we are adopting NPV criteria. So let us see how to calculate the answer. Heading right down. Calculation of NPV of the project. In that, column number 1 is year, column number 2 is cash flow, third column is discounting factor at 25%, and the last column is present value of cash flow. First year cash inflow is 4,000, second year it is 7,000, and third year it is 18,000. This is end of year 1 to end of year 3 cash inflow. So 1 divided by 1.25. First year factor is 80 paise. Second year factor is 64 paise. Third year factor is 51.20 paise. This is end of year 1 to end of year 3 present value factor. Now the same will be discounted in present value term. 4,000 into 0.8, that is 3,200. 7,000 into 0.64, 4,480. 18,000 into 0.512, 9,216. The total of all of them is present value of the cash inflow. It is 16896. So whatever I am going to receive in future has present value or discounted value of 16,896, and the amount of investment is 10,000. So difference of both of them is NPV. The amount of NPV is 6896. We understand that the NPV of the project is positive, so we should buy the machinery. Right on answer. As NPV of the project is positive, comma, the company should accept the project. Full stop.